Thank you so much for joining us. This is awesome. If you'd like to bring it in, we're going to make this super casual because it's a small group, even though we have the mics and the lights. So feel free to come up forward. Plenty of wonderful seats up here. They're actually the massaging leather ones, so pretty fantastic. I'm Chris Strayer, CEO of Revaluate, and you may see on the seats some envelopes. If you open those up, there's a link in there that you can follow now or later, and you can set yourself up with a borrower retention assessment appointment. So if you'd like to do that, we'll talk more about that later, but for now, I'll let these guys introduce themselves. Jason.
Sure, I'm Jason Frazier. I'm the EVP of Growth for Lead Pops, but I'm also a strategic advisor to Lender Price and Victorian Finance.
Jay?
And my name is Jay Voorhees. I'm the founder of JVM Lending, and we're a very tech-forward lender because we don't have loan officers and we can get immediate tech adoption with everything. So our entire operation is automated in every way possible. Thank you.
Awesome.
I have a biased crowd here.
So then Molly McKinley on our team is going to be out with a mic. There she is. And so we're going to ask questions and just, raise your hand, flag down Molly, and we'll get some feedback from you. Shall we sit?
Yeah, I think we should.
Good.
Awesome. So let's kind of take this conversational arc on a past, present, and future. Like what was working from a data standpoint previously that was really kicking ass? And then what's working now and where do we think it's going to go in the future? All right?
Yeah.
Jason, you want to start?
Sure. Honestly, when you're looking at it, I think the data hasn't really changed. I think the difference that I see between data being utilized in the past and today, it needs to be highly focused on signals, right? When you ask any normal CEO of a lender or service provider or whatnot, when they think of data, they're thinking of spreadsheets, data, birth dates, maybe some buying habits or whatnot, depending on what data you're looking at. But I think ultimately you have to be intelligent about your intelligence, right? And so you got to look for signals, and signals could come in all forms of fashion, and you're only going to get that data. But data is not enough. You actually have to have some business intelligence built into it so you could read those signals, because at the end of the day, our industry is really built on reactive, especially with marketing. Mm-hmm. We're reacting to everything, whether it's a loan anniversary or someone did this, so we're going to do that. You really should be nurturing all the time, because those clients are your clients before they even know who you are. So you only know that through signals, so that way you could be at the right time and the right place, because the consumer journey is no longer linear like it used to be.
And describe what a signal in your world looks like.
Well, it depends on, again, the data set, what you're looking at. But if I took on, like when I was doing consumer direct and I was looking at buying habits, or if you were looking at when Facebook, before you were in the special ad category, when you could actually look at what people were doing, and they would tell you, hey, this person's a renter, and maybe they have some credit card debt, and maybe they went on Amazon and bought some things, then they paid down some debt on their credit card, and a few other things, and then you could use a predictive analytics engine to say, oh, this person is probably thinking about selling their house, okay, right? Or this person's thinking about buying, downselling, they have kids in college, so you take all of that data together, and that, in essence, creates signals, so you could then form the right message at the right time.
Jay, how about in the past for you? What have you seen that has really worked well?
Very similar. So we did a very good job of mining data similar, and also attacking our database when I think of data. And we do a great job of staying in front of them. We send out about 30,000 emails a week, and we do everything possible with ad targeting and you name it else. But what I've seen is over the last 6 months especially, that just staying in front of your database is no longer enough, and even relationships are no longer enough. What's become more and more preeminent, especially with our average loan amount in our market of being about $700,000, is interest rate. So before, if you mined your database efficiently and stayed in front of your clients, you were king. You could keep them coming back to you no matter what. Now we're seeing much more aggressive rate shopping just because of the nature of the market and because there's so much more competition. So we loved the way it was working 6 months to a year ago, and right now it's a much tougher proposition.
So what's the hurdle? What do you have to overcome if it's not about, or if it is about price, what do you have to overcome?
So marketing used to be largely involved just sharing valuable information. I blogged every day. We send out newsletters. People love what we send. But now it seems like rate is almost everything with our high-end borrowers. Or our lower-end borrowers in our Texas and Arizona markets is not quite as important. But in our Bay Area market in particular, rate is everything. So we really have to market rate, which requires us to use technology to become a low-cost producer. And that's what we're focusing on very heavily right now.
And for the crowd here, what markets are you in besides the Bay Area?
Bay Area and Texas are our primary markets. We're also in Arizona and in Massachusetts as well.
And your markets?
38 states right now, but Atlanta, I would say the Southeast primarily.
Does anyone want to jump in on that? Are you seeing different signals? Are you seeing different trend? Is rate king right now driving those buying decisions? Raise your hand for Molly and she'll come up to you if you want to jump in.
I would like to see a show of hands of people who still want to say that they're not selling rate. Okay.
0. Okay, that was 0, just in case you guys couldn't count through the room. That's awesome. Okay, so going back to this signal and working the entire database. The database in your world is just people that you've worked with in the past? Is it separate? Is that separate from, say, leads that you've purchased and haven't transacted with, or?
We never purchase leads, so we'll reach out and do marketing, digital marketing. We have a very powerful website with tremendous SEO presence, so we get a lot of organic business that way. That's something I recommend everybody do. It took us a long time to do that, but we have a very powerful website with great SEO presence, like I just said, and that brings in about 25% of our leads. The rest of our leads come in primarily from referrals from real estate agents and from past clients, and that's the way we nurture our business, because we played the purchase lead game for a while, but it was so competitive it didn't work out that well for our model. And we still do quite well with bringing the leads in. The issue for us is just keeping them because everybody is so rate sensitive, even though our rates are very low for a mortgage bank.
Has competition for leads in the last 6 to 12 months increased or decreased?
Well, on the purchase lead front, I mean, Jason would know better than I, but I think it's increased. I mean, we tried to play the purchase lead game through Bankrate a couple years ago. I remember when the market was similar to what it is right now, and it was just brutally competitive. I couldn't believe it, and I can't believe people could compete in that arena.
And thus the shift to bringing it in-house.
Entirely in-house. We've always had that primary focus where we bring in all of our leads through referrals.
Similar, different?
I would say it's the same. I agree 100% with Jay about a website, especially blogging. Because here's the thing is that we rely on everyone else to feed us our deals, right? We focus more on people we don't know than the people we do know, right? And Jay obviously has a dialed in process to convert those people that he does know in his database and not go and purchase leads. The problem with purchasing leads, we've all seen the ads, we've all seen everyone post, but at the end of the day, if everyone's giving you 16, leads are not hard, right? I just want to throw that out there. Getting leads is not hard. Getting prospects is difficult. Getting customers, right? That's what you want. Leads are not hard to get, but you need to go out there, and you can only do that by owning the traffic. And you can't own the traffic if you're paying Zillow, paying Realtor.com, and again, I'm not digging on those things. I'm just saying, any of that can change at a heartbeat, and you have no control. And then what do you do? If you've built your entire business on a channel that you have no control over, then what do you do? So the only way you do that is, Jay has the perfect example, and I get your newsletters, and they're awesome, and I got this way before I met you, is you have traffic that you own through your newsletter, that's one-to-one. People come to your website, SEO, that's stuff that you could absolutely control, but you can't do it through purchasing leads because those are rental relationships. They're not deep relationships like you do have in your database, so it's important to focus on that.
It's literally, in our world, in our language, it's renting versus owning. Absolutely.
Right, and you have to be able, like we talk about that in the industry for everything else except for our own business, right? Yeah. So you have to own your traffic, you have to own your database, but instead of focusing on all these other things, because generally our industry gets an idea that you get a lead, it's like a deal on a platter, knowing that and I did consumer direct for 2 years, and I could tell you that's a 9 to 12 month cycle. Usually, right? And same with purchase leads. Now, they're not hard to get. It's just the fact that with housing prices being where they are, rates being what they are, what they qualified for, 12 months ago or 6 months ago when they're waiting for the bottom to fall out, right? Now they can't afford that. And so it's just, it's there. You just have to be a little bit more creative on how you're going to convert them.
So the creativity is kind of where I want to go to next. Let's talk about the creative things that you've done, through this last 12 months. to stay on top of the business? And maybe there's some groundwork that you did lay previously,
Yeah.
or maybe it's something brand new that you're testing out in the last 6 months. Do you want to speak to that?
Sure. So I'm also a coach for next level loan officers. And so what I coach my loan officers on 100% is hyper-local marketing, right? Because at the end of the day, we're all selling the same stuff, right? Or FHA, VA, USDA, refi, purchase, jumbo, non-QM, give or take, right? And we're all selling the same thing. So how do you really stand out? How do you be a differentiator in that? And so what I tell my loan officers is blogging, YouTube, start talking about the local market, because people aren't, understanding this is nobody wants a mortgage, right? Even though my shirt says I love mortgages, but nobody wants a mortgage. No one wakes up saying, oh, I want to be $100,000 in debt. I want to do all this paperwork. I want to open up my taxes and everyone to someone I don't know. No one wants that. They want the home, right? So as mortgage professionals, we need to be focused on selling what people actually care about, which is the community they're going to live in, where their kids are going to go to school, where they're going to do their shopping, right? And the home that they have. And sometimes rate doesn't matter to a certain extent when you're doing that. And so the messaging has to be about where they're going to spend the majority of their time, and that's the home and the market. So I've had great success with doing hyperlocal videos, having them doing hyperlocal content, which is restaurants with business. And look, every business owner will open that up. Every agent would be happy to go and do an interview with you, talk about a local business. And I've done this and get 2,000 views overnight, because that's what people are searching for. We got to focus on intent, right? No one goes to Facebook to look for a mortgage, right? They go on YouTube to search for a mortgage. So why not add that to a community like, hey, I live in Alpharetta, Georgia. Getting a mortgage in Alpharetta, Georgia. Why don't you do a video about that and then talk about the community, right? But then also do, hey, living in Alpharetta, Georgia, moving to Alpharetta, Georgia, because that's what people are searching for. So at the end of the day, we need to stop thinking about, we're not the audience. Stop creating content for yourselves. Create content for the people that you're trying to convert.
So it's no longer talking about rate in his world. It's talking about the basics of home ownership and the things that we really, the consumer, the end consumer, the initial keynote was talking about, that same type of thing, right? Let's get back to those basics of what the consumer wants.
Exactly. That's the same game we play, exactly. So we provide as much value-add information as we possibly can through our newsletters and our blogs and everything else, and consumers love it. However, we've discovered with our high-end clients, like in the Bay Area, even though they love it, they come back to us, our open rates on our blogs and our newsletters are extremely high, and we get compliments nonstop. They still will leave us if there's a big rate differential. And so as creative as we can get with our marketing, it still is ineffective compared to some of the banks that have one word on their marketing, 4.5%. And that's what First Republic in the Bay Area is doing right now. They just market that one rate. That's all they have to do. There's no creativity. There's nothing else. It's just, here's our rate.
Right.
And that's what we've seen be more and more effective over the last 6 months, because borrowers are just simply much, much more rate sensitive. But again, it's the higher loan amounts. Under about $300,000, I have a lot of acquaintances in different markets where they seem to be doing quite well without the rate competition when loan amounts get below that level.
So there were 6.1 million purchases last year.
Yep.
Someone can yell at me, the number is close to there, or I'm way off. But the projections for the rest of this year are where right now? Where are you seeing?
A total of about 5 million for the year, that I just read.
Yeah.
Right. So that's definitely a downturn, but it's just a reset of back to 2018, 2019.
Exactly.
Yep.
So it's not the sky is falling, or it is the sky is falling.
To me, I look at it as a different market, and with when you have shifts, you have opportunities. So I think it's just I think everyone needs to stop focusing on comparing the last 2 years. Those are unicorn years. They're not going to happen all the time. Stop waiting for the refi, savior to come around. It's just it may not. Look, something could happen we don't know about.
The refi savior.
I just made it up, right? But it's just one of those things that you really gotta look at the dynamics of today, and that's also educating your consumer, talking about, hey, can you afford this? Do you want this home? Do you want to live in this community? Great. At some point, as they always do, and you have to ask questions, right? Like, how long do you plan on living here? I plan on living here for 15 years. Great. Then historically, rates will come down. Can you afford this right now? If something happened, would you still be able to afford it? Yes. Then let's do it now. And when rates come down, I'll do a refinance. So it really is just having that conversation without forcing them. But to Jay's point, when we talk about selling rates or that, first rule of marketing is don't waste your time selling the unsellable. If their number one priority is rate, then it doesn't matter sing and dance, add free tacos. It doesn't matter. Like it's not going to happen. Well, I don't know. Maybe tacos might be a little bit too far, but either way, like that's what you really got to focus on. Is I think we got lazy the last 2 years, and I mean that kindly, but like lazy the last 2 years because you could just kick a can down the road and run into 15 refi possibilities. But look, I mean, I think on average we tend to do about 5.5 million real estate transactions in a given year. It's running at 1.3 to 1.5 trillion.
Yeah.
So we're just getting back to the equilibrium, honestly, if you think about from, 2016 to 2019 or 2017 to 2019. So I think you just have to compete, and we're still doing deals. I know loan officers that, yes, they're not doing 20 units a month, they're doing 10.
Yeah.
And that's still great, you know what I mean? So the deals are there. Houses before, no houses were coming on the market. Now I got 10.
Yeah.
So people are still selling, and it's all market driven.
And it's not, they're not trying to buy out of in Aspen, right? They're not buying on the coast right now. They're not buying those second homes at inflated prices.
Exactly.
They're buying for their family.
But I was going to add too, you mentioned earlier if the sky is falling, and I'm going to say the sky did fall about halfway to the ground when the refi boom ended.
Yeah.
So we have way too much capacity in our industry
Yeah.
right now too. So that's what's hurting too. There's so much competition because of all that excess capacity. And then the big banks have come back in too, and they're competing much more aggressively too. So the sky fell another quarter way to the ground because of that. So it's a pretty aggressive market right now.
For sure, the people that are moving right now are moving for the exact same reasons that they have been moving since the dawn of time, right? And that's where Revaluate works, is in that sphere where people are. We call it this is cheesy. You guys can laugh if you want. But we call it the data Ds, and you may know some of these. So death, divorce, diapers, diamonds, diplomas, downsizing, discretionary income, the daily grind, dumpsters, right? These are the things that cause people to move. That hasn't changed. Those people are still going to move. That 5 million plus that we're talking about that are going to move this year are still out there. And so using data to find those people, to have those conversations, to get the ball rolling is, I think, what we're talking about and where we are in the present. Those people are still going to be moving.
Yeah, which is why we're big fans of Revaluate. We use you for our own database, and we also, as a big pitch when we develop real estate agent partnerships too, is we sell that as well. So we're big fans of Revaluate for exactly that reason.
Oh, thank you for
You're
that.
welcome.
I appreciate it.
Yeah, my pleasure.
Are you looking at that customer life cycle differently now than you were previously, or is that sort of in your ethos?
Well, I think, again, it comes back to messaging. It's like, you know, at the end of the day, a goal for every lender, every loan officer should be customer lifetime value, right? For the most part, we're like, oh, we got that deal. It's $5,000 commission, let's say. I actually want $150,000 value of that relationship, and then X, how many people are in my database.
Yeah.
And so I think, you know, that life cycle, one is having data that helps so that you can talk to them in the right way, but it's also asking questions. You mentioned like the Ds, right? Same thing is like, you know, how many times when, you know, someone was, why does someone want to do a refi? Because to save money. It goes deeper than that. It's one of those. That's why. And so if you're messaging and the data that you're using, and I'm putting it out there, if I'm competing with everyone and everyone's like, hey, lower your monthly payment, cool. But if I put messaging out there, lower your monthly payment so that you can start saving for college, lower your monthly payment based off of all the reasons why someone actually gets a refi, that messaging will win out over the generic stuff that we put out there.
Anyone want to jump in at this point? Raise your hand and Molly will come find you with questions or comments on here. So here you go, Molly, up front, please. So it's this idea of switching from a linear process of get the lead, work it until it closed, now it's done, you know, throw it away, or work it till it's dead, now it's done, versus a customer life cycle and lifetime value.
Quick question: what was the D in dumpster? Like, what's that motivator?
Yeah, it's not uncommon to find. So on the real estate side of the coin, real estate agents have been known to drive neighborhoods looking for dumpsters, because when there is a dumpster in the driveway or out in the street, that is a strong indicator, not all the time, that there's a high propensity that address will be turning over soon. They're remodeling, they're throwing away trash to move out of the place, grandma died, whatever it is, that there's a correlation with dumpsters and moving.
With COVID, aren't there other things that are motivating people to move because they can work anywhere, and so they're looking for homes with offices and things like that?
Oh, absolutely.
Different.
absolutely.
What all are you seeing as far as COVID moves?
So it really depends on the market. So we saw that a lot in Atlanta, from Atlanta proper to more. So we have other, probably none of these cities are going to mean anything to you, but we have Cumming and even a little higher. But it's like when I no longer have to drive in Atlanta traffic, I could live, an hour away, and it's not a big deal. I get taxes are better, a lot more land, bigger house, better schools. And then you obviously seen the news stories and whatever. If you look at the migration from California, New York, and New Jersey, and some of these other states that were a little bit more restrictive, and the ability to remote, it's like, man, I no longer have to do the rat race anymore. I was born and raised in the San Francisco Bay Area, so I know all about traffic and being packed in, with everyone, and then housing prices and going over the mountain to try to commute in, and it sucks because you're spending 3 hours in the car a day, and you just got 3 hours of your life back times 5 days a week, times 52 weeks a year. And you just realize that it's a better quality of life, and that's why you see such a response to the companies that want that return to work, which is funny because I think what we found is that we actually still can be efficient and do our business by not working in an office, even though there is value of having people together. So I think everyone's still finding their way. And with the labor market being what it is, companies will find out. I think that the biggest, if you look at commercial, I don't know about where you guys live, but where it's vacant, 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 vacant. 5%, like an 85% or 90% vacancy rate. And so there's a lot of commercial opportunity there as well.
Yeah. In Denver area, I know the commercial space downtown is around under 50% vacant still. Workers are not returning to the numbers that they thought. They're definitely working.
San Francisco is the worst market in the country right now. It's an absolute ghost town. 'Cause it's not just because, tech, most of downtown San Francisco was dominated by tech filling those offices, and they were the most remote group there is, and they all moved. And COVID really warped our local market too, because all those tech workers came from San Francisco, moved out to the East Bay. We're headquartered in Walnut Creek, California. And it really inflated the market out there, and that's still the case to this day because they're able to come out there and work, but they still wanted to be close enough to their employer to go in every now and then. But they didn't want to go to another state, so they came out to Walnut Creek, Danville, the East Bay corridor, and that really, really warped the market.
So we're seeing on the downward trend of those COVID-oriented moves, right? And we're coming back to normal from the reason that people are moving is what we're seeing. But that kind of brings us, I think, in this conversation to how about the future and where we're pointed to in the future, and how we see using data to market to people, and what's going to move the needle in the next 6 to 12 months.
So I hate to be a broken record, but I think it's going to stay right. So it's not so much data per se, it's technology. And so we are focused extremely heavily on technology and also moving a lot of our labor overseas to virtual assistants, something else we're very skilled at. And we actually have Tammy Richards helping us here. She's one of the preeminent experts in the whole field. And so one of the things we use right now is Candor. I'm sure a lot of people here are using Candor too to underwrite our conforming files. And it's turning out to be very effective. And I'm delighted with how efficient it's become. And Tammy is telling us they're going to be able to roll it out for our much more complex jumbo files. So that's the key. You want to figure out what kind of technology you can use, because the data we think we have figured out. We know how to bring the leads in. We know how to do everything else. We just want to make sure we retain all that business we're getting by being able to offer a low enough rate. And that's going to come down to lowering our costs through technology and virtual assistant help.
So saying that again, lowering the cost via automation and efficiency and some outsourcing.
Absolutely.
So not building everything in-house.
Yeah, exactly.
Not doing everything in-house.
Well, we'll do it in-house, but we'll use technology to do it in-house. So we'll have a lot of technology partners like what Tammy offers in order to lower our costs. And we will not be able to compete unless we do that. And I think mortgage banks that aren't on that bandwagon are going to be in a world of hurt. In fact, I don't think it, I know it.
Yeah.
Yeah.
Okay.
Yes.
Next 6 to 12 months?
Yeah, and I think one thing that we have to do as an industry is stop being a people problem-solving industry and be a technology-solving industry. And what I mean by that is our industry tends to throw people at problems and challenges. We just saw it the last 2 years. That's why everyone is just getting shot out of a cannon now, because it just doesn't pencil anymore. And I get it, But what I see is we did all this stuff the last 2 years. We didn't stop patting yourself on the back. We didn't do it because we wanted to. We did it because we had to, right? With demand, right? And so what I would say now is that right now there should be a hyper focus on innovation and automation and technology, not removing the human. Technology is not to replace; it's to enhance the experts and the professionals, and that's what we need in our industry. Every other industry does that in some form or fashion, but for some reason we think we're different, and we're not. But had companies started focusing really on technology, Candor's an excellent example of that, then we wouldn't, the expenses wouldn't be so, because it costs money to fire people. You got to understand that. It costs money for everything that's happening right now. That's why you see a lot of lenders struggle. I think, what was it, 2 months ago or a month ago, the amount of companies that were actually profitable was, I think, like 52% of the industry. Everyone else was like losing 80 basis points a loan, right? And so that isn't sustainable, and you only do that through making the right investments in automation and technology, but also understanding is that we can't get that twisted. You cannot mistake efficiency for effectiveness. It may be efficient for us, it may be an efficient process, but it may not be effective in the long term. So that happy medium that Venn diagram is, you got efficiency, you got effectiveness right there in the middle. That's where you need to focus on, and that's where you need to build. Efficiency, effectiveness, automation, outsourcing. Okay. Any more questions in the spirit there? I believe in what you're saying, and I think that is the future. I see automation and intelligence driving a plan, right? So that's obviously, we believe very strongly in using data to drive action, right? That's the key. So let's find those customers in their customer life cycle where they're more likely to be moving, and then send them the appropriate message so that a human can work with them and bring the deal in, bring that prospect back in. Well, that's how you're going to win, because everyone else is going to do exactly what we've always done all the time, right? Be different, right? Stand out. You cannot stand out by doing the same thing as everyone else, right? And a lot of people are going to just use the data to do the same thing, but if you actually use data intelligently, that's when you're going to get to them first, and that's where the ball game is.
Agreed. And no matter how good your technology data gets, you still need somebody to communicate with the borrower because they want their hand held. Yep. That's what we're discovered, interestingly, with our super tech-oriented clients in the Bay Area. That they make $300,000-$400,000 a year. They're very sophisticated. They have master's degrees, but they still want their hand held throughout the front end of the transaction. So the key is, after we spending all that time on our end to hold their hands, we want to make sure we retain those clients. Is that going to last? I mean, that's where consumers are today. Is that gonna? I think it will, because of the size and the importance of the transaction. There are just so many questions. There's a lot more complexity behind a purchase transaction that consumers just aren't aware of, and they want to have those questions answered. So you can automate up to that handshake. Exactly, and then you have to have a very skilled consumer interface, a person that does the hand holding. Excellent. Further questions, guys? Awesome. So that's I think a pretty good picture of where we've been, where we are today, and kind of going forward. And I guess with that, I'll let you guys add final comments here. I'll just repeat what I've been saying. So I don't want to get away from data too and Revaluate. So the value adds are key. So that's again why we use Revaluate, because we can share that kind of information with our agent partners, and we're going to continue to share valuable information using all the data we cultivate. But I'm just hyper focused on technology, because I think that's the only way to compete in the future, because rates are going to become more and more of a factor, especially as loan amounts continue to climb. And so if you don't embrace tech in every way, you're not going to be able to survive throughout the long run. Yep, and when you say you're not going to be able to survive, how many originator contraction are you thinking? If we're at 575 is the last number I heard? I think we'll see about a 50% contraction, yeah. In what period of time? Over the next couple of years. Yeah.
I agree with that, and just to add to what Jay was saying earlier, is that I think what COVID taught us, I think everyone maybe, and even myself included, might have thought like, hey, we're ready for that full automated, technology driven. And I think what happened with COVID is when we all got locked down and we stopped having that human interaction, and all the technology's there. Like, in fact, it's even been enhanced, but I think people have then realize we're not ready to cut off complete human interaction. You do need, no matter where you come from, you want that human interaction. You want to feel comfortable being able to ask a question. It doesn't need to be like the whole time, but you want to be able to have a human to talk to. And I think we all just like, look, we get enough Zoom calls, enough, hey, you're on mute. Like we've said that how many times? Like now we really need that human interaction back.
Excellent. Well, thanks very much, Jay, Jason. Very much appreciate your time.
My pleasure.
Thank you very much, guys.
All right.